Welcome, and thank you for watching the deal preview for Flats at Stones Crossing, the latest investment opportunity sponsored by Great Capital. In this video, I'm going to be breaking down why we believe that Flats at Stones Crossing is a compelling multifamily investment opportunity in 2025, despite market uncertainty, because we are confident of the specific submarkets fundamentals, the fundamentals of Indianapolis, Indiana, and the Midwest. We think it's one of the most interesting places to invest right now, especially because there's uncertainty in the market, which allowed us to place this property under contract at an incredible price below the cost of replacement. And we're essentially buying a brand new developed property, developed just in 2024, for less than what it would cost to build today, but without taking the time to actually build the property in an environment where there is almost no new supply coming into the market over the next several years. There's an incredible amount of demand. Current rent growth is positive despite inventory that's been coming online the past couple of years. And the market is right in the sweet spot for Great Capital's in-house property management arm, Gray Residential. So strap in, we're going to give you a video preview of what the property looks like, get into the business plan, what we're going to do to the property to add value, force appreciation, generate strong yields, and why in general we think it's a safe place to park your cash, again, to deliver yield and overall upside in 2025 when finding good investment opportunities is not exactly easy to do. So let's just jump right into it and look at some of the features of Flats at Stones Crossing. As you can see, Flats at Stones Crossing is a newly developed property with a beautiful lake with a walking trail around it. It's nestled in the path of progress on the south side of Indianapolis in Greenwood, specifically in Center Grove Township. Center Grove, it's considered to be the Carmel of the South Side. Carmel is the absolute most affluent area in Indianapolis, but this is the next second best, highest growing area besides those northern suburbs, boasting strong demographics, strong population growth, and again, Flats at Stones Crossing is center of the path of progress. A new Franciscan Health Center was developed. Retail is going in right across the road, which has already been developed, and additional developments have been laid out all around Flats at Stones Crossing. Strong incomes, strong population growth, and an amenity set to match. There's no wonder why the property's already started to see strong demand. As we're taking a tour just through the clubhouse, you see a beautiful aqua lounge connected to the leasing center right next to the resort-style pool and amenities, the bocce ball, grilling areas, lounge chairs, exactly what renters in Greenwood are looking for. But we're not going to stop there. We have a targeted value add plan to really upgrade the amenities across the site. Again, they did a good job on the development side, putting in kind of the basic and required amenities, but we found in this era, 2025 and onward, amenities win. Marketing wins, and being able to take attractive marketing photos and videos allows us to increase traffic and increase demand. As you saw, they've got an incredible walking path around this lake, a nice looking dog park. But you can see the dog park, there's no real features. We want to add some features to the dog park. We want to add additional benches, fire pits, hammocks, sitting areas all around the walking trail. The fitness center is already in great condition. In general, we want to do what I call an amenity bomb, really to upscale the amenity offerings at the site so we can better compete against the nearby competition. Again, the units are in great condition. The in-house amenities in the clubhouse are top-notch, but we can still elevate the overall curb appeal by adding those sitting areas, but also upgrading the landscape around the property as well. As you can see, Flats at Stones Crossing was originally built in a cornfield. We want to take away those cornfield vibes. As the development surrounds the property, we want to make sure that it fits in to the area incredibly well. Now, while we're looking at some of the interior features, I want to jump into the business plan for Flats at Stones Crossing, give you some details of why we believe it's a very compelling investment, especially, again, in a time of uncertainty in the multifamily market. First, let's just jump into the broader details of the acquisition. So we mentioned it's in Indianapolis and Greenwood submarket, specifically in Center Grove, which is one of the top school districts in the state of Indiana. In terms of the property itself, as I mentioned, it was built in 2024. There are 292 units, and our purchase price of $66 million comes out to right at $226,000 per unit, below the current cost to what it would take to build this property today. We're offering an 8% preferred return, a very attractive 80-20 LP-GP split with no second waterfall or tier, 5 years of projected hold period, although there is a possibility of a longer-term hold with a refinance around that 5-year mark. But we're looking to return capital by year 5. Right now, current projections put the total return at a 16.23 net to LPs in terms of your internal rate of return, equity multiple over 5 years right at 2x, and an average cash-on-cash return coming in right at 7%, making the return profile incredibly attractive for a high-quality A-class asset in a growing market with the demographics are just absolutely off the chart. This is one of the best risk-adjusted investments I've seen in quite some time. Let's continue to dig in. A little bit first, just about Gray Capital, is we're in the business not to lose investor capital. We've never lost an investor dollar, and we have no plans to do so. We've never had to issue a secondary capital call where we had cash flow shortfall of cash. We've also never raised or had to or are planning to raise a preferred equity rescue fund to bail out our own deals. And we believe that if we buy right, which is buying below replacement costs, if we finance right, which means putting in long-term fixed rate debt, and if we manage right with our own in-house property management company, Gray Residential, which we're driven by a drive to give great customer service, we believe in having a hospitality mindset. And that goes for not just our residents, but our investors as well. If we do those 3 things, we will see success. And that's why the Gray Capital portfolio is not in distress and is thriving in 2025. We don't have any upcoming loan maturities. We believe in operational excellence. And last but not least, we are co-investing right alongside you. Typically, Gray Capital is putting in at least 10 up to 25% of the deal's equity, of our own equity, into the deal. Our average co-invest is 14%, and we are looking at investing upwards and even more than $3 million into flats at Stones Crossing. We've got a great team, a vertically integrated operation from construction, design, property management, as well as market intelligence and research. That's something you'll find at every multifamily shop. We're proud of our leadership team. We're also proud of our track record as well. You can get all this full track record and more in the Flats at Stones Crossing deck. If you haven't gotten access, make sure that you have an account on the Gray Capital Investor Portal. You can go to graycap.net and get more information there. But long story short, we've got a full cycle on 11 individual projects, an average IRR of 28%, and we still have 15 active projects still cooking with an average cash-on-cash of 7.8%. A little bit more about Flats at Stone Crossing and why we think it's an absolute incredible deal is, again, buying below what it would cost to build it. If I asked you, if we developed a new property today with supply receding at a precipitous pace, if we could build something today and deliver it fully leased up tomorrow, would we do it? Absolutely. Because in an environment with an incredible amount of growth, it's harder to buy a home than it ever has. So the demand for rental housing is higher than it's been in decades, and especially in A-class assets. Again, those individuals that would have been buying a home, they can no longer afford to do so. So what are they doing? They're looking at renting, and they're looking at renting at a nice property with all of the amenities, maybe a garage, maybe probably looking for a pool and probably a dog park as well. But we can't just buy right and assume that organic rent growth is going to continue to carry us. We're always looking to add value through a creative business plan. And when at this property, where all the units are in great shape, the amenity set is pretty good, we ask ourselves what could really move the needle, because nothing is really broken at the property. Well, one thing that often gets reduced in terms of the budget for a developer are some of the amenities and landscaping, especially in an environment where costs are rising. And so one thing that I noticed on my initial tour, several tours at Flats at Stones Crossing, is that the landscaping was a little bare, and they had all this great open space with a really nice walking trail that goes around the property. But what they were missing is some amenities that would really draw it out. More sitting areas, more fire pits, more benches, some additional hammocks. And also, I looked at the dog park. Nice looking enclosed fence dog park, but it could use some equipment, could use a bench, and some of those extra details that looks like just got cut out of the budget when it was being developed. So I'm calling this an amenity bomb, but where we're going in and just scattering well-placed amenities throughout the site that have individual opportunities for folks to sit, relax, and call Flats at Stones Crossing home. Not only that, but we were going to do some targeted interior enhancements, including some furnished units where we'll be releasing out at a higher rate, but also we'll implement our short-term rental strategy where we take a small percentage of the units and list them on short-term rental sites, driving 2 to 3x the revenue on a given month than a traditional unit would produce. We're doing this successfully at different Gray Capital properties with a lot of success. And there are very few hotels in this area, in Greenwood, in the Center Grove Township, so we think this is a great opportunity to enhance revenue and drive yields. The demographics at Flats at Stones Crossing are some of the best that we've seen for any acquisition that Gray Capital has done in our entire history. The population, the 1 mile population growth around Flats has grown by 119% since 2010. Greenwood itself has grown by 24% since 2010. The average household income is $115,000 in a 1 mile radius, $95,000 for Greenwood itself. And the average home value goes up the closer you get to the property, showing more affluence. 1 mile radius from the property, it's $347,000. In Greenwood, it's $250,000. Again, this is suburban Indianapolis. The further you go south, it gets a little bit more rural. So these are relatively moderate numbers. And you see that we're buying Flats at Stones Crossing, price per unit well below all of these averages. So why do we love it? It's a premier location. It's absolutely in the path of progress with new retail development going in across the street and surrounding the property as we speak. Literally, the shovels are already moving. The submarket growth is unprecedented for the Midwest. This is the type of growth that you would find in some of the fastest growing regions in the Sun Belt. We're using moderate leverage, fixed rate debt, so we'll remove interest rate risk from the deal over the term of the investment. And going in at a moderate 70% loan to value finds a nice balance of risk-adjusted returns, but also enough leverage to drive cash-on-cash yields. It's in our backyard in terms of our ability to manage the property. The property is 20 minutes from the Gray Capital headquarters and just minutes from other Gray Capital projects, allowing us to share site teams, resources, and manage the property more efficiently through our centralized management teams. Again, the cash flow is incredibly attractive. 7% average over the hold period, really starting out at the gate strong, close to 6% and growing from there, with rent growth assumptions lower than our current portfolio is experiencing and lower than the property is currently achieving today. So we are really discounting the rent growth that we believe that we'll probably be able to get in our underwriting model, trying to be conservative as there was a significant amount of supply delivered in the submarket over the last several years. But all of that delivery is essentially behind us with just one property finishing their lease up. But during that lease up period, we've seen more demand in the submarket than ever before. I'll jump to that over on a CoStar report just in a second. But first, what are the fees that we're charging for this investment? Minimum, some of the deal terms. We do have a $100,000 investment minimum. We are offering an 8% preferred return with an 80-20 split. I mentioned the return profiles of 7% average cash on cash, 16.25 projected IRR, that's net to LPs, and a 2x equity multiple over 5 years. In terms of the fees we charge, some of the lowest in the industry. 1.5% asset acquisition fee, a 1% loan guarantee fee, 3% property management fee, and a 2% asset management fee on gross receipts. We distribute monthly and we report monthly as well. Let's look at some of the detailed demographics for flats at Stones Crossing in the area around, including Greenwood, Center Grove. Talking within a 2-mile radius and a 5-mile radius specifically. In 2020, the population around flats, 2-mile radius, was 20,700. By 2024, again, 2-mile radius, it was 21,136. Projected in 2029, the population is projected to be 22,400. The annual growth rate between 2024 and 2029, that's right where we are, is at 1.3%. That rate of growth accelerated from the previous 4-year period, which was 0.5%. The median age of a 2-mile radius is 37. That's right in the core renting demographic and perfect for an A-class community where the rent may be a little bit higher than your B or C class, but they're starting to enter those peak earning years. 44% of individuals in a 2-mile radius have a bachelor's degree or higher. That's a very affluent area, especially in Indiana. Looking at housing, again, the average median, the home value, then 2-mile radius is $315,000, 5 miles, $231,000. So it gets a little bit nicer the closer you get to flats. The median year built is also a full decade newer, 2001 versus 91. Again, we're right in the path of progress. In terms of household growth, again, we're looking at a 1.3% projected growth rate between 2024. And the average household size is right at 2.8. In terms of incomes, strong incomes in the area. One direct correlation between the successful investments that we've made at Great Capital is directly linked to income demographics. Average household income, $127,000 within a 2-mile radius. That's versus $103,000 within a 5-mile radius. Now looking at median, which is probably the better metric to use for a 2-mile radius, $95,000, 5-mile radius, $80,000. Again, it gets a little more affluent the closer you get to flats at Stones Crossing, which is why we're seeing so much development and retail development all around this area. And then when you bifurcate the different amount of households that are making different income brackets, it's pretty impressive, with quite a few folks making well over $200,000 annually. Again, just looking at the annual population growth, all very favorable. Population by age, pretty well distributed, to be honest. Good amount in the 2024, but really this 25 to 34, which is really our primary target demo, is very strong. And as well as 35 to 44. But also the other demographic that's going to be living here are going to be empty nesters. So the 65 to 84, even the 55 to 64 being at a healthy range is good to see. Again, this is a very diversified community in terms of age. Now looking at some household income figures as well. Again, we've got a lot of folks that are earning between $50K to $75K, but the $75K to $100K, which is kind of an ideal range for the rents at flats at Stones Crossing, both of these bands can easily afford to live at flats at Stones Crossing, so ample prospects to lease these apartments. Here we're looking at household income by age. And it's interesting to note that the vast majority of households are owner-occupied. There's not that much renter-occupied household, about 29% over the total. That this percentage has been increasing as there are many new Class A apartments in the area where there traditionally were not. But this also lines up with the fact that, again, it's harder to purchase a home as an individual. Those mortgage payments are significantly higher. Those down payments are significantly higher. And the quality of the rental offerings is greatly improved to where it was several years ago. We're now looking at some of the market fundamentals in the submarket. I'm just looking at absorption to start. An incredible amount of absorption throughout 2023 and 2024 after some weaker years in 21 and 2022. We saw this in many markets across the United States, but these are multi-decade highs in terms of absorption levels. The submarket was absorbing anywhere from 150 to 250 units in a given quarter, and they were not delivering that many units overall. You can see the daily vacancy rate certainly spiked in August of 24 as new units were delivered, but those units were absorbed, and that vacancy rate is down lower than it was in August of 24. looking at the vacancy rate, including the property, you can see a really strong lease up. This line starts up here at 0% occupancy and a high vacancy. That's obviously the property when it was delivered. Starting in 2023, it's fully stabilized in 2024 and is now more occupied than the average in the county in the 3- and 5-star properties in the county itself, showing incredible demand for apartments in the area generally, but also for flats at Stones Crossing. Vacancy by bedroom here, we see that the 2 bedrooms have the lowest amount of vacancy. The 3 bedrooms currently have the highest amount of vacancy. Sorry, the studios have the lowest, with the 3 bedrooms having the highest amount of vacancy, with the 1 and 2 bedrooms kind of right in the middle, hovering around 7% vacancy. Rent growth is moving in the right direction in terms of market rate assumptions. The property kind of fluctuated a little bit about raising, lowering rental rates as they were moving towards stabilization. They also utilized concessions, as almost all of the new properties in the submarket were utilizing high rates of concessions. But if we look at that concession activity, scroll down a little bit here, you can see that those concessions have started to burn off. All right, let's look at construction activity. You can see starting in 22, but throughout 2023 and 2024, we had a good amount of deliveries, especially relative to history. Traditionally, there's not a lot of development activity in this region submarket, although it was really still developing in terms of moving from the north to south. There's only one property that's forecasted to deliver during the hold period that is known about. That's about 280 units. And again, Johnson County was absorbing the 250 units in just a single quarter. So one property that's going to deliver in 2026 is not a major concern. If anything, it's an indication of developer interest in Johnson County. I would imagine that more properties would start over the hold period, but given current financing constraints, specifically equity for new developments, not anticipating anything to start in the immediate future. It could take 2 to 3 years from a property to be fully built once it's permitted and they get started. So we're looking several years into our investment window when when those properties would be delivered, and it costs significantly more to build new construction today than it did to build flats at Stone Crossing, meaning that any new development that would be delivered would have to be asking significantly higher rents, which puts flats at Stones Crossing in a great position to either move our rents to narrow the spread or to have a healthy spread between the new rents into increased occupancy. Again, looking at the starts and under construction, the number has been falling off significantly. I mentioned some new retail development in the area. This is just one rendering of a proposed retail development which will be immediately adjacent to flats at Stones Crossing. But that is not the only thing. Not only has a new Franciscan hospital opened up several hundred yards away from flats at Stones Crossing, but new grocery stores are going in. A new Meijer is being developed right on 135, which is the main retail artery adjacent to flats at Stones Crossing. But a slew of new development, primarily retail and medical, are all being slotted around the area of flats at Stone Crossing, giving our residents an incredible amount of walkability, dining options, entertainment options that make suburban living more than just living out in the rural area, but allowing someone to really never needing to go into Indianapolis proper. You can stay in Greenwood, stay in Center Grove, and have a great living experience. Well, there's a lot to love about flats at Stones Crossing, and I think it's incredibly well risk adjusted in nature. There are always risks in any investment, and I wanted to highlight some of the risks that we've identified that could really throw a wrench in the gears of this investment. There is somewhat limited highway access. There is good access to flats at Stones Crossing. Again, 135 is a strong retail corridor. However, the access compared to maybe some other sites is not as ideal. As you see, I-69 to the west and I-65 out to the east are about 10 minutes. It's about a 10-minute drive. And 31, which is the road that cuts through the center of Indianapolis, is about a 7-minute drive. I would probably prefer to see the interstate a little bit closer, but given that the amount of retail offerings in the immediate area still makes me comfortable for the investment. But it's certainly one of the things that I don't love about the property or its location. Increased rental competition. There has been additional units that have delivered in the Center Grove submarket recently. In Greenwood, as I mentioned, there's one other property that will most likely deliver kind of mid to late 2026. Most likely there won't be a ton of new construction in the area given those financing constraints, but new rental competition, when they start adding concessions, can retard our ability to increase rents and drive yields. Again, we have a pretty good idea of what's coming down the pipe, and we've seen in the past, the last couple of years, new supply has been absorbed at record levels. So we probably should see some new development in the area, but that's one thing to keep in mind, that if developers just start pummeling Johnson County and Greenwood, we could see a reduction in our ability to drive rents. Some natural disaster exposure. Hurricanes can come through this area. Tornadoes, not hurricanes, can come through this area. There was a tornado when the property was being developed that came through and touched one of the buildings. It was under construction, so we had plenty of time to fix it. It's been re-inspected. We're conducting ample due diligence. But tornadoes do occasionally happen in the state of Indiana. Although being an Indiana resident almost all my life, one has never significantly impacted my life, and I've really never seen a tornado. I kind of wish I would at some point, but they are serious. Take in mind. Rising uncontrollable expenses. I mean, we're living in a challenging operating environment. That's why we've made a lot of strategic decisions at our corporate level of how we centrally manage a lot of our properties. We're bringing more things in-house, doing at the corporate office, such as accounts receivables, leasing, centralizing some of our maintenance operations. But, turn costs, contract services, materials, all of those things have gone up, and they could go up even more, and that could hamper our ability to deliver returns. Again, operational risk. Great capital and great residential, we could mess this thing up. Even though it's stabilized, it's operating smoothly, and we have a track record of taking underperforming and performing properties and accelerating their growth, there's no guarantee that we'll do an incredible job. The only guarantee that I can provide is that we will do our absolute best because we're passionate about it. We're passionate about managing properties the right way, having a hospitality mindset at all of our sites, and delivering for residents and investors. But there's no guarantee. Even with those risks understood, Flats at Stones Crossing presents a very attractive risk-adjusted return profile, delivering returns that are more in line with a value-add risk profile, but really taking the risk of a core asset itself. Again, the demographics are an incredible tailwind to continue to push Flats at Stones Crossing, where mistakes can be made and that organic growth should make it up. But as mistakes are not made and our value add strategy comes to fruition and we operate the property as we will, do a very good job, we'll be able to drive returns that are well above what one would expect for a risk profile that is low as Flats at Stones Crossing is. And as evidence, I'd point to one of our more successful properties, which has a very similar strategy and risk and return profile. It was purchased in a time of uncertainty during 2020, kind of in the middle of the pandemic. It's an Indiana property up near South Bend, Indiana. It's a property called Villas on Fur. We've had an incredible amount of success managing this property more efficiently, reducing concessions, increasing rents over time, keeping expenses in line, and seeing consistent net operating growth. That property itself has been distributing over 15% cash on cash for the last several years, partially due to really attractive debt and leverage. But again, a testament to our strategy in an environment where rates were so low and we could have gotten a more flexible floating rate loan. We opted for a long-term fixed rate loan on Villas on Fur, and because of that, we have not had any of the issues related to rising carrying costs, rising interest rate costs, and the stress and distress that many multifamily operators are experiencing because of our discipline and our ability to understand that risks are real and that interest rates could have gone up. Even when industry experts are telling us that there's no way interest rates could rise. We knew that wasn't the case. We decided to take those low interest rates, fix it, in this case for 35 years at Villas on Fur, and our investors have been reaping the benefits ever since. Taking a look at the competition, Flats at Stones Crossing is well positioned. We're not the highest in the market, but we do present, I think, some of the best value, and that's before we get in there and execute our value add plan. There are 3 other properties that have higher average per square foot rents and also nominal rent levels. These properties were built around the same time or after Flats at Stones Crossing was built. But in terms of just an average rent, nominally, actually there are 5 properties that are higher. In terms of 1 bedrooms, there's also 5 properties that are higher in rents, where 1 bedroom rents at Flats at Stones Crossing come out at around $1,400. The next highest property is around $1,475, giving us about $75 of headroom at the property itself. When we look at 2 bedroom rents, kind of average rents at Flats are basically $1,750, with the highest in the market coming in just below $2,000. For 3 bedroom rents at Flats at Stones Crossing, costs you a little over $2,000, which is an absolute steal. We have 3 bedroom properties that were built 10 years ago that are going much more than they're charging at Flats at Stones Crossing. But the next highest is going to be close to $2,200. That's almost a $200 spread for those 3 bedroom units for Flats compared to the competition. Thank you for taking the time to watch this deal preview for Flats at Stones Crossing. If you're ready to make a decision, hop on the Great Capital Investment Portal and indicate your interest today. If you have more questions, feel free to reach out to myself or any member of the Great Capital Investment team. Blake Peroni and Griffin Haddad would love to have a conversation with you. I can jump on that call as well. Their contact information is below, but there will be links below this video as well to schedule a meeting or get into the deal room to start your due diligence, look at all the data, look at the deck, and make your informed decision right on the Great Capital Investment Portal. We make the process easy. Fill out all of your documents online, connect your bank account, fund your investment, sit back, and let Great Capital do the heavy lifting. Again, any questions, please reach out. We're incredibly excited for this opportunity. We're excited to partner with you on this deal. This is an interesting time. A lot of folks are on the sideline, but those individuals that see the opportunity with clarity are the ones that will see success. All right, we'll see you on the next deal.